Okay, go ahead and start it, Troy.
Hello, everyone out there. This is the weekly market update for the week of May 4th to May 10th. Hi, we're the House Heroes. My name is Troy. This is
Ryan.
Hey.
Ryan.
And we're here to give you a weekly market update, what the big news items were in the week, and to show you the numbers here in Southern California of what's actually happening, what the actives are, what the pendings are, what the solds are, what are we seeing as trends in the market that week of the 4th through the 10th, and what we're seeing in the future as well. So Ryan, what have you seen that's in the news that's newsworthy?
Well, let's jump into it. Biggest thing, that we're looking at are these key items here. So it's the business science, the health science, and the people science. And we want to know on the business side, what is the economy done in the past when we've had, huge pandemics and things like that and slowdowns, and how has it bounced back? So that's what we want to look at is past reactions and then try and figure out how is it going to react this time as much as possible. So we've been reading a lot of articles on that and looking a lot of that data. Then obviously health science, when will COVID-19, be under control? Originally it was flattening the curve. Now people are talking more about finding a cure. People are, worried that, are we even going to be able to? So we've been paying attention to all that as well. And then you've got people science, just how long before people get back to their normal lives and their normal spending habits. So we've been looking at that as well. And obviously we're looking at everything and seeing how it relates to real estate. So, we've been picking through a lot of different news sites, listening to a lot of different economists, and that's what we're here to bring to you today. One of the biggest things that Troy likes to put together is the Bureau of Labor Statistics. He's out there. Who's got a job and who doesn't? So what do we got today, Troy?
So, we look at this, and obviously every state's different. This is the United States as a whole. Who absolutely is being unemployed? We keep hearing it, on a weekly basis, these ungodly numbers of first-time unemployments. And then we're not really hearing about how many people are employed. If you notice that, they really have no idea because all these states are so inundated by the unemployment that keeps coming in. Here in the state of California, the EDD is just overrun, right? They open themselves up to, I think it's 24 hours now, or these extended hours. I don't know what it is, and they're still behind. Still, people are complaining. But when we break it down, in a real estate kind of focus, right? What we're looking for is who actually can pay their mortgage, or who actually is out there, a mortgage holder, and who actually is looking to be a mortgage holder. Those are the two, pots that we're actually looking at. So if we look at the slide here, we're going to see who actually is unemployed, right? So if you look at the biggest part, almost a little over 33% is, your workers, servers, bartenders. So it's actually in kind of that service industry. Yep. Those are the people that are hurting, the most. Those are the ones that are actually going out and, hitting the unemployment button and receiving unemployment. Then I look at the next two, big pieces here of this pie. And one of them is temporary workers. So, all these temp agencies that are out there, most of them are not even around anymore, right? Or they're on hold, or they're furloughed, right? Absolutely. So everybody underneath them are furloughed. And then you have the retail industry. And we can absolutely see this. Any one of you that's walked through a mall, the majority of people that are in retail are going to be the younger crowd, right? So you're looking at the teenager, young 20s or something like that. And so if we look at this as a whole, right around 58 to 60%, we're talking the majority of people here, probably 90-95%, are really not mortgage holders or future mortgage holders in that they're looking within the next 6 months.
Yeah. So we're not going to see a huge instant impact from this, and so if we're starting to get people back to work and starting to open up the economy again, hopefully those that are mortgage holders and those that are looking to be mortgage holders in the near future aren't going to get at this potential second wave they're talking about and be affected by that. And so that's why we're absolutely looking at this chart, every week as it's being revised and stuff like that. So it's good. And I just know, I'm also, paying attention with my eyes. So
eyeball test.
We're in a complex that has, lawyers, doctors, dentists, and we see people going into all of those offices all the time. The other day, I actually had to go to the doctor's I didn't even realize it's almost been a year since I broke my foot. And he says, I was asking him, like, how's it been? What's going on? He didn't shut down at all. He said, hey, we slowed down to maybe the 4 critical people we needed to see a day. We really spaced them out. We were trying to be very careful, but he's like, I had to keep everything open and rolling. So, I think that's going to keep a lot of these doctors' offices, the A&E manufacturer, childcare, a lot of these things still, kept rolling.
Yeah, and actually, if you really look at that, most of those statistics are all from April. And if we look at April itself, we know that was kind of the big panic moment. It was the second half of March and then April. So people were, the big unknown was out there about the coronavirus. Today, I think people settled in a little bit, and they're a little bit past or done with this whole scare tactic that I think a lot of the governors and other institutions that are throwing numbers out at everybody. And I think we're seeing this normalization slowly coming in. And I personally think it's a revolution amongst, especially here in Southern California, it's a revolution amongst business owners and actual workers, blue collar workers that want to get back to work, that are not seeing the death rates that were predicted at the very beginning. And we're not even seeing a fraction of that.
Well, and it was interesting. I was reading an article the other day about Potbelly, right? The sandwich shop. And they was talking about their 100 stores that are closing. And then as you get deeper into the article, I think it was over 2/3 of those stores that they're closing were already unprofitable. So even before this, they were taking losses in these stores. They were just bad locations, had bad traffic, what have you. And these are corporate-owned stores. They weren't franchises. And so they were just, why even reopen? They're already closed. Let's just go ahead and shutter them and move forward and find other locations to expand in the future. So it wasn't that all of their company, was doing bad and they had to slice 100 out. It was they were cutting out the fat of that pork belly right off the bat. And so I think you're going to see some trimming of the fat. I think you're going to see certain businesses not reopen because they just didn't have the profit. You're going to see other businesses move to a new business model. And so it's going to be very interesting to see how everybody adapts from this. And, right off the bat, we saw the initial plunge in showings here. And this is one of the things we talked about, because this took, again, some of the fat off the top, the froth. When you're coming in and you got 12 offers on a property, all of a sudden you're like, okay, I'm still up against 3 other serious buyers, but the other 9 might not be around. And that's what we saw in this segment here, right? And so now we're now in this segment over the last 3-4 weeks here, where everything is skyrocketing again in showings. You're seeing a lot of the secondary locations. So out of the urban cores, and past the suburbs even, you're starting to see those markets really catch on fire. So like for us around here, we've got some different resort areas that are traditionally second home. And a lot of people are looking at moving there, 1, permanently, and 2, looking to get their second homes because they're realizing this might be the new normal. We might be going through some waves of this, and they want to be able to go do their Zoom calls from the mountains or the desert or the river, and just be able to relax and enjoy where they're at. So we're expecting to see a lot of those markets really catch on fire again. And we already are seeing it. I mean, I know we're doing a couple of deals that are exactly, fall into that basket. So.
Well, good. Let's get in the numbers. I mean, let's go see what the meat and potatoes is. So I picked a couple counties out here. I wanted to kind of show you some of the differences that are happening here in Southern California. If we look at LA County, and it's very similar, actually these numbers are very similar to Orange County in that percentages. We keep seeing that there's becoming more and more active properties on the market. And we're seeing a little bit of decline on the solds. Now, the solds are always 30-day trails, right? So
roughly probably 30 to 45 days right in there, yeah.
So we're talking about right when the COVID hit, right? When people were in the stay-home order, right? Stay home, that's right in the middle of March to, and actually it's going on today, but when people really did had that fear in them, it was the middle of March to basically the middle of April. So these are the numbers that we're typically looking at as we see the solds fall. Now, if I look at actives, they're increasing. But what we're seeing for the future, what we're seeing is the pendings. If you look at this week's pendings and you look at the last 4 trailing weeks, you keep seeing it build and build and build. And literally, Ryan and I say this all the time, if you look at the pending and the sold for last week, it far exceeds the amount of listings that came on the market. So we're actually still shaving off a lot of properties, and we're having less and less stay on the market for a elongated time. I know that the last time we looked at it, the California Association of Realtors and the MLS, they talked about, right around a 2-month inventory. So, I mean, that's historic. I mean, you're looking at, we're still
it's
historic.
Insane. So if no new homes get listed on the MLS, they will sell out. Real estate agents will sell out of homes in 2 months. And
right.
That is across the entire price point spectrum. That's what's so crazy about it.
That is crazy. And it's held that way now for the past, since the beginning of 2020. In January to now, it's all held out that way. It's just the pendings are still just keep coming in. People are wanting to buy homes, right? They see an opportunity right now with COVID-19. I've had that on many of my clients that I've put in escrow lately. It's I got to get in now because there might be there might not be the same opportunity I'm going to have in the next 30 or 60 days.
And that's a great point. You've got to take that opportunity now. Pull the trigger now. We're looking at one of the news articles we didn't get time to get up here, but JP Morgan Chase just created a partnership with American Home for Rent. Mm-hmm. They're one of the largest single family residence rental companies out there. They own over 55,000 single family residence homes that they rent out. And, people are always kind of keeping eyes on what are they doing? Are they going to start selling any of that off? No, they just entered a partnership and they are going to build new single family residence homes in Las Vegas to rent. Mm-hmm. So they realize that we have an absolute shortage of housing, of single family residences. And what is their solution? Hey, we're just going to go build them. And so that's what they're doing. And so when you see things like that, when you see big money and smart money putting their money into new single family homes, that tells you something.
It's a joint venture, right? Yep. You see that joint venture, and if you look at Wells Fargo or any of these major institutions, they have not been into that space at all, ever. And so this is something new. Again, if I go back to January and February, we saw that Freddie Mac came out and said we're 3.3 million homes short of the actual buying pool that's out there. And so now you're now all these joint ventures are starting to happen where they want to actually rent. They want to have people rent a little bit longer to build their brand, right? To build their brand and to build their profit margin, right?
And they've been talking about this for years. I know we were out at a single family investment forum what was that, a year and a half, 2 years ago now?
It was December 20.
And they were talking about it then. Hey, this is the next big space. And now we're actually seeing it, come to fruition, and they're pulling the trigger on these things. So they're completely unaffected by this, and they realize we've got a shortage of housing. So where are we at with the median price?
So this is interesting, and this is why, when we hear all the negative news out there, regardless of if sales are down, what's more important to everybody who owns a home? Well, where's the values at? Where did my home plummet in price? And that's very worrisome to people, right? People talk about forbearances that are out there. Now, Freddie Mac came out and said they're doing 12-month forbearances, which is something we'll probably put together next week about the forbearance market, because that's a whole nother market, a whole nother segment that we're really dealing with. Where's my home at? And this actual chart in Los Angeles, even though we're slower on the actual sales in last week, we're looking at a bump in the median home price, which is crazy.
And this is one of the things we were expecting to see, a huge drop in the median home price, because you have to remember what a median is. It means half the number, half of the amount of sales. So if there was, 1,000 sales in a month, half of them were below a certain price and half of them were above a certain price, right? So 500 and 500, like what is that middle price right in the middle there? And that is what the median is. And so when you have things like lending that is tighter on the high-end market, when you have people that don't need to buy that $4 million home because their $2.5 million home is just fine to wait out, COVID and things like that and the shelter in place. When you don't see the high-end sell, what you get is you get more number of homes on the low end, and you expect to see this get driven down, and we haven't seen that. And so those are some of the first headlines we expected to come out where, median home price plummets, and people to react negatively, and that becomes a tail that wags the dog, and then people get worried just because of this statistic that's coming out that they don't even understand. And they don't understand why this price is getting driven lower. And so for us to see that, hey, it's not even really coming down much anyways, is very nice to see. It really shows you that the deals are getting done.
Well, and to me, it's even scarier. what happens if more and more people go back to work and more people are looking to buy homes? Where's this number going?
Oh yeah, it's.
I mean, let's be honest. When people say to me, "Hey Troy, I want to wait till after the COVID, after coronavirus is gone." Well, first of all, when I don't got the crystal ball, and the 900 hotline, the genie.
They blocked your number.
Right,
there.
they already blocked my number. Right, the phone company won't let me dial
Miss
anymore.
Cleo
right?
does not want to talk to you anymore.
Right.
I know why you're calling.
So what we're seeing here is the opportunity of buying is slowly, and the affordability is slowly going away for the entry-level homes that are actually in Los Angeles County.
Well, and the fuel to the fire, you got the Fed over there just throwing money at it, Jay Powell with his printer. And so what do you have? You've got these low interest rates that are fueling this, so you have people that want to own a home. They don't want to be tenants. They want to feel like they've got control of their own destiny, especially in a situation like this. With coronavirus, some people are like, oh, I just want to sit back and wait and see what happens. Some people they have that anxiety and they want to know that they've got some sort of control over this. And one of those ways is by getting out of a rental that they don't know what control they have and getting into a home where they own it and they have a mortgage. They have a servicer that they can deal with directly. So.
Yeah, very good, man. So San Bernardino County. So now here's a contrast, right?
And this is really interesting because, LA and Orange County are pretty similar where they have a lot of high-end pricing homes as well. San Bernardino and Riverside have less so. And so that's why we picked one from each county, to really focus on this week. And San Bernardino is where we picked from the Inland Empire. And, as we talked about, active stayed pretty solid through the COVID. Sold stayed pretty solid. But what's amazing is the pendings have absolutely caught on fire here too. These are where you see more of the affordable and entry-level homes of San Bernardino and Riverside County. And this is where we talk about they're completely flying off their shelves. There's just not enough inventory out there. And it's scary that there's just not enough, to be honest with you. And I think if you pulled this market in and of itself, it's probably under 2 months of inventory.
Oh yeah.
And this is where it is.
And
you just see the pendings just through the roof.
I'll say this, Ryan. Last Sunday I went out and showed homes. I had 2 clients in the San Bernardino, actually all weekend. I actually had 3 in the San Bernardino vicinity right there around the actual city of San Bernardino, Highland, Colton. Actually, if you really look at it, any home that's halfway decent that looks nice is immediately it's in escrow. And then you see the homes that are sitting on the market. And you either see a home that's 6 days on the market and in escrow, or you see a home 40, 50, 60 days on the market and their prices are going down because those owners were a little bit, little too happy about looking at these high numbers coming in, but not putting the dollars into the home to make it desirable for millennials to acquire, to put their offers in. And I'm seeing that a lot. And a couple things, and I shot this over to you last Sunday, and it's very interesting. I actually asked, everybody wants to get notified when we go show homes. So I asked the agent, hey, I like to show the home at 4:00, and he says, well, we're not. His quote to me, it's active on the MLS. His quote to me on a text was, we're not showing until the coronavirus is gone. And so my response to him on the text was, well, why is it active right now on the MLS?
Put it on hold.
And he said, not your problem. And I'm like,
and it is my problem because my clients see it. It shows up active. They ask about it. They want to know about it. They're wondering, hey, is this the house for me? Well, I don't really want to commit on writing an offer over here because I'm thinking this might be better, but you haven't even seen inside yet. And so, those homes need to be moved on hold. There are a lot of homes that are just sitting on the sidelines that are in that position. You might have somebody who's thinking about selling but doesn't want to take the risk and stuff like that. I really hope some of those properties start to get shown and get moved to active because we absolutely have buyers out there for them.
Right.
There's no doubt about it.
And to go back over this, this chart just kind of reflects what we're talking about. If we look at last week's pendings, they are so significantly higher alone than the actives in San Bernardino County. I will say this, we are going to see a bump in the next 60 days, 30 to 60 days. We're going to see, in my mind, probably a 7 to 8% bump in the median home price in San Bernardino. Mark my words. You're going to see entry-level people start to be pushed out, and the numbers started going up and up. So you're gonna have better buyers, and the entry level people at 200, 220, 230 are just now falling off. Now the affordability is getting pushed out to the high desert, or even as far as Hemet. Right, we're not even in the city of San Bernardino anymore.
Yeah,
in those surrounding areas, those metropolitan areas. So let's go look at medium home. This is interesting. As we
jumped up and came back down
right,
to normal.
It did. It took or the 4-week average. It jumped way up for a couple weeks, and now it's come down a little bit because I think that we're starting to see people feel they're grasping at homes that they can afford, and those homes, there's just not very many of them at that 220, 230, 240 price range. And so now they're just grabbing at them. And that's causing the medium home price to go down, even though, pendings are shooting through the roof and sales are steady.
Yep. Well, and it's interesting because even when you look at active inventory out there, I'd say there's at least a third that are just either non-financeable or non-saleable to a typical first-time home buyer or even a second-time home buyer because, we see it in the private remarks, what you guys see when you look at Zillow or online or even on the MLS, the front end is the description, the public remarks. The back end has a private remarks, and that's where it says things like, "Oh, this home has a tenant in it, and the tenant, the lease runs through October. You get to take it with the tenant in place." Well, you can't get a loan on that property. So that ain't gonna work unless you're cash or hard money. And then now you're taking over that potential issue with the tenant. Are they really gonna move? Are they really paying rent? All that kind of stuff. Yeah. And there are a lot of those out there that are active. And the average Joe public looking at a listing on Zillow thinks, "Oh, we'll see the market slow because that thing's been on the market for 3 months. It's overpriced." No, it's got a tenant in it, and you can't buy it. With normal financing, and it's not priced cheap enough to where it makes sense for an investor to take the risk of taking it on with a tenant that they don't know and then deal with getting them out later. So, there's a lot of that kind of stuff out there, or the property is very dated, or it doesn't meet, lending guidelines as far as FHA and VA and stuff like that. So it's very interesting because what gets left as these things sell off and burn off, it really is, kind of the junk out there.
Yeah, I mean, in fact, last weekend I saw a lot of properties that were tenant occupied, and to write the offer subject to. And subject to means you can't go in the house. You have to get an offer accepted prior to you actually entering the house, and then then you can go in, and the tenants are there, and then it's a negotiation with the seller and the tenants when they can get out. So definitely take that in consideration, everyone out there. When you're looking at homes. You start seeing stuff that's dated. There's or has high days on market, or DOM has a high, let's say anywhere from 45 plus. Then that I always call there's an issue. There's something that you can't see that is causing this property to actually sit on the market. If it's not overpriced, it's impossible to see. If it's not impossible to see, the financing is not available for it to make enough people, the entire market, to actually want to look at this home and put an offer in. So
if you guys are sitting on the sideline, you're thinking about selling a house, an investment property, a rental, anything like that, it needs work, reach out to your agent. Most good agents out there, they've got contractors who can come in there and do carpet and paint, have it financeable, and they can make it easy to show so you can get that top dollar as well. I know we just did one out here in the IE. They were thinking about just dumping it on the market for $250 and selling it as is for less than $15,000. I think ended up being about $12,000. They had roof repairs, scraped the ceilings, painted the entire house, new carpet, did some plumbing updates and quick fixes and stuff. And we got multiple offers on that thing now at $330. So
that's crazy, isn't it?
It really is. To see that turnaround. What 12 grand can bring you. Just to be able to open that up to people that have financing.
And I really feel bad, Ryan, when I'm actually showing a home. I showed one this morning, and the house it just showed terrible.
It's worse.
I mean, it's like you want to kind of give them little pointers. Hey, do this, do that. But it's not your listing, and you're kind of tampering. So you got to watch it. But I mean, I really feel bad because I'm like, these people who've lived there for 5, 10, 15 years, and they feel the lived-in feel is just not what today's younger millennial buyer wants to see.
Yep.
Like, they want to run out. They're not want to buy grandma's house. They want to buy George Jetson's house.
Yeah.
Right? They want that new upgraded,
That's awesome.
sleek, futuristic, feel. They do not want grandma and grandpa's house. They don't.
Somehow you managed to say something really old and really new in the same sentence.
Is that called relevance?
That's pretty funny.
All right. Well, everybody, thank you very much for the weekly market update. We will put this out for you every single week. If you have anyone that might benefit from this, definitely hit the follow button. If you're on YouTube, hit the subscribe button. We need to get that going. We just literally launched our YouTube here last couple weeks. We've been putting a lot of content on there, and we really would appreciate, hit the subscribe button. We want to kind of build this up, and we're not here every single month. We're not here every 6 months or quarterly. We want to give you this information on a weekly basis so we keep you the most current and accurate information available.
Yep, absolutely. So please, if you like what you see here, share it, with your friends. Go ahead and tag them on this. If you didn't like what you see, share it with your enemies. We'll take it either way. But definitely check out our YouTube channel because it's a little bit easier to sort out and see the weekly updates in order. You can kind of trace back, the last 2 months and see what we've been seeing as far as trends and stuff like that. So that way, when you're ready to enter the market, you'll have a very good idea of what's been happening and what's really been going on in the trenches. So please like us, follow us, and share us. Other than that, have a great week, and we'll see you next week.
See you next week. Take care. Be safe.